Stay calm, evaluate investments, and monitor geopolitical impacts on markets.
All over again. Should I be panicking?
That is the right question, and history gives us a nuanced answer. Let me share both sides honestly.
Let's hear it.
The case for concern: the oil shock is real, the strait is disrupted, inflation was already above the Fed's target before this started, and the conflict shows no sign of quick resolution. President Trump has said it could last weeks, possibly much longer. That combination is genuinely worrying.
And the case for calm.
A few things are different now compared to 1973. The United States is a net oil exporter today. We have far more energy independence than we did 50 years ago. The Strategic Petroleum Reserve, which was actually created because of the 1973 crisis, exists precisely to cushion shocks like this one. And one energy trader at CIBC put it well this week. She said the crude market has been extremely measured so far. No panic. Professionals are treating this as a disruption, not yet a catastrophe.
And here's the historical stat that I think our listeners really need to hear. Over the last 9 decades, analysts have studied every major geopolitical event: wars, terrorist attacks, assassinations, financial crises. And the finding is clear. Emotion-driven sell-offs during geopolitical events are almost always short-lived, and investors who panic and sell almost always regret it.
History implies that if a crash event does occur, it would be a buying opportunity for patient, long-term investors. That has been true after every single major conflict since World War II.
Every single one.
The investors who made money in the 1970s oil crisis weren't the ones who sold everything when the embargo hit. They were the ones who repositioned thoughtfully and waited. So let's get practical. What do you actually do right now? 3 moves.
Move 1. Don't make panic decisions. The single most expensive thing most investors do in a crisis is sell at the bottom out of fear. If your financial plan was sound before last weekend, it didn't suddenly become unsound because of what happened in the Persian Gulf. Volatility is uncomfortable. It is not the same as danger.
Move 2. Look at your energy exposure. Oil companies like Exxon and Chevron actually rise when oil prices spike. Their profits go up. Defense stocks like Northrop Grumman and Lockheed Martin are also historically strong in conflict periods. This doesn't mean chase hot stocks, but if you have zero energy or defense exposure in your portfolio, this is a moment to think about whether that balance makes sense.
Move 3. Watch the Strait of Hormuz, not the headlines. The single variable that will determine whether this is a brief disruption or a prolonged economic event is whether the strait reopens. Every week it stays closed, the pressure on global oil supplies compounds.